Welcome to Oregon Cash Flow Pro. My name is James Barber, here to help you maximize that cash flow. Today is our IUL illustration day while in policy review. Although I don't have an illustration set up ready to go, I have something even better for you guys today. So stick around. We've got a lot of things to go over. If you're an agent out there, you might find a lot of value in this. We're basically going to look at a comparison that I've been putting together for a while now between a whole bunch of IUL products that are out there. So my team has seen this before. We're still in the process of basically adding to it and improving it. But I wanted something that was an easy reference that we can easily look at and point out the differences between a lot of the top IUL products. So this is not a comprehensive list. It doesn't include everybody, but it includes most of the top IUL products out there. So I have one ask of you. If you're an agent out there, if you have access and the time and you're interested in putting together a design to help me fill in the blanks on this, I would appreciate it. And obviously, this is good for our community to have access to. And there's always value in my mind of making this type of stuff available to the consumers if you're interested in them being able to choose the best product for themselves. And since that is always my goal, that's what we do. That's why we do this. And that's why we put it all out here. So welcome. If you're just joining us, put in the comments. Let me know if you can hear me okay. And as we go through this, if you have any questions, obviously put them in the comment. If you're watching this afterwards, I try and answer every question that shows up in the comments. Remember, Tuesdays are IUL days. We're going to focus on IULs in this live stream. Thursdays are going to be whole life. This Thursday, we have a whole life policy review. It'll be a PennMutual policy. So pretty cool. It looks, I briefly glanced at it. Looks like a well-designed policy. So it's going to be pretty informative, I think. And let's move into my spreadsheet that we've been working on. So here we go. There are a couple other carriers here. So we'll go through all these real quick. Some of them right here at the end, we don't have them completely filled out. So this is where you guys might be able to help me out. I was licensed with AIG, now called CoreBridge, or I was contracted with them, but I never sold their product. And so they just took that away. And I didn't design one of these illustrations before I lost access. So if you still have access, do me a favor. I'm going to explain to you the parameters of this. Do an illustration for me, send it to me. And then I can fill this in, or you can just tell me which ones. Tell me the answers to these to fill in for anything that I'm missing. So here we go. On the left, we've got Allianz Life Pro Plus Advantage. Then we have the F&G Path Setter, PacLife Discovery Accelerator IUL2. Some of these are going to be changing here in the near future as well, especially once AG 49B comes out in May. So the value of this is going to be short-lived once these new products come in, but we'll update it. So I'll do another video after we get all the changes in place. We'll update these and do our best to keep you guys up to date. Gil, thanks. Hope you're doing well. Okay, so National Life, their Flex Life product. North American, Builder Plus 2. Securian, PennMutual. The PennMutual, this is the accumulator IUL. So on some of these, if they have multiple IULs, I do try and specify which one we're looking at. This one is accumulation, AIUL for PennMutual. And I'm going to have some more on this one when we get into the numbers here, because there's some interesting things that I noticed here. Then we have Transamerica. This is their older product, not the new one. I'll have to get the name up there on that one. Just know this is their old product. They have a new product that came out the beginning of 2023. These are the numbers for the old product. Mutual of Omaha, Nationwide, AIG, and Columbus Life. So those are our contenders. Let's start off here. So Allianz happens to be my top selling product. So I have that one locked in here at the side. I tend to always compare what these numbers show in all these different columns. Now, I've sold more than just Allianz. I think last year I sold Allianz, F&G, National Life, North American, and Securian. I think that's it. So I think I sold 5 different carriers, IULs, last year. Yeah. There can be some certain circumstances where some work better than others. And then, of course, some clients just prefer to get that particular product. So this is just an overall guideline. It doesn't necessarily mean that your client or you should choose one or the other. You're going to take all of these factors into consideration. You're going to get an illustration demonstrating how that product is going to best meet your goals. So some of these may not compare as well to the other ones here on this chart, but it doesn't mean that product is necessarily not the best one for your situation. So something to keep in mind. This comparison is for a 40-year-old male, non-tobacco. The numbers change based on your age, your gender, and obviously your health rating. So I just chose a standard non-tobacco. That's your average non-smoking 40-year-old male. That's what that means. Okay. Underlying insurance costs are a little less expensive if you get preferred ratings. If you're female, the insurance expenses are a little lower. The MEC limits are also lower. So something to keep in mind. But we're going to go over the different policy designs. The value in this spreadsheet is to compare these products with all the same parameters. That's essentially what we're trying to look at. So we have the minimum death benefit. This row is the minimum death benefit that you can sell this product with. Okay, you can see here with Allianz, $100,000 is the minimum. This is for the base face amount. Okay, F&G Path Center will go down to $50,000. PacLife will go down to $40,000. National Life will go to $25,000. Although actually, they've made some recent changes. It was actually $100,000, but you could do a blended design that made it that base face amount lower. So that's why this says 25. Something to keep in mind. Okay, you may not see a total death benefit of less than 100,000 with the National Life. North American 100,000, Securian 100,000, but they'll do 50,000 for minors. So 100,000 for adults, 50,000 for minors. PennMutual 50,000, Transamerica 100,000, Mutual of Omaha 100,000, and Nationwide 100,000. Why is this important? Well, if you have a client that wants a very low premium, let's say that they want to put like $50 a month into a policy or less than 100. You may need to go with a product that allows you to do less than 100,000 in base death benefit amount. That product, despite any of the other changes, could perhaps perform better because the underlying expenses are simply going to be lower right out of the gate. And if they're not planning on funding it at a higher level, there's oftentimes no reason to just go with a higher death benefit because you get some other benefits to go along with that. That ends up being why we've sold some of these other products. They can just look better if somebody only ever wants to put in a smaller dollar amount, and we want to make sure that that policy is going to survive and even perhaps thrive at that low dollar amount. Next column, max blended design. So if you've spent any time on my channel, you know we always try and design our policies for the lowest possible commission. When it comes to generating a policy that has the highest cash value, not just in the early years, but every year in the policy, that usually entails some type of a blended design where we're going to have our base face amount, and then we're going to blend in some non-commissionable term insurance. The base face amount determines the commission. Everything else that we can add to it increases the MEC limit, usually increases the MEC limit, and doesn't affect the commission. So we have very low costs, even though our MEC limit just went up by quite a bit. So with Allianz, we can do a 10-to-1 split design. This next column is our scaled up blend. So look at these, consider these two together. So with the max blended design, we have a base of 100,000 death benefit. which means we have 100,000 base and we can do 10 times as much in a blended design, which is a total death benefit of $1.1 million. Okay. That gets us a MEC. So that our MEC in this case is going to be at the scaled up blend, or if we can't scale up, or if it scales at a different amount, we've just done 1 million in total death benefit. Okay. So the MEC at the scaled blended amount, in this case, it's 1.1 million death benefit, would mean you could put in $64,000 a year into this policy, 64,344. The target premium tells us what the commissions are going to be for this product. Okay. Generally, most agents make 100% of target premium for their first year commission. After that, it's a small recurring amount. Now, those numbers can vary depending on who they're contracted with, how their contract is set up, if they're with a multi-level marketing organization. Those things can all change. So like realistically, any agent on the street could earn anywhere from like 25% of target premium up to over 100% of target premium, depending on how their contracts are set up. For your purpose as a client, just assume the commission is going to be 100% of target premium. It's just a nice, easy way to figure out if you're paying more fees or less fees in your policy, because somebody's getting that commission. If it's a multi-level marketing organization, and the agent is making 25% of target premium, their upline is likely getting another 25%, and their upline's getting another 25%, and their upline's getting another 25. Like it all gets spread out there. Okay. And then the FMOs, the company at the very top that does a contracting between the carriers and the agents, they're going to get an override fee as well. So there's expenses that are all built into that target premium indicates to us if your expenses are going to be higher or lower. So that's a nice, easy way to think about it. Just assume that's the commission for the first year. It's a small number after that. But one of the biggest impacts in your policy is how much is that target premium? Okay. So ideally, we want to see a lower target premium. Not necessarily between different carriers, because the products are going to be slightly different. But when you get a design in any particular carrier, you want the lowest possible target premium. There is almost no product out there that if you see a lower target premium, it's not going to perform better than a higher target premium. Okay. In the IUL space, it can be different in whole life. Okay. But in the IUL space, totally different. The lower the target premium, most likely the more the cash value is going to be down the road. There's a small exception to that, and that could be that non-commissionable term insurance does come with a slightly higher cost than the commissionable term insurance if you just look at the cost of insurance. Now, there's other fees inside of an IUL where they recoup commissions. So in general, you might pay a little bit more for the insurance, but you're going to save thousands or tens of thousands on commissions. And it's certainly worthwhile to do it that way. So the small caveat in there is just look at your illustration and make sure that the actual cost of insurance on that is not so much higher that it doesn't make up for the reduction in commission. Okay. And we'll get into that. There's a couple of products that we're going to look at here farther on into this spreadsheet, where we're going to talk about something like that, where they don't actually allow a blended design, or they might allow a blended design, but there's not a benefit to using it. So target premium, that's your commissions, essentially. We want to see that lower. In this case, and then we have our minimum premium. So this is minimum premium for the scaled up blend. So at 1.1 million in death benefit here for Allianz, the minimum amount you have to put in each year, $37.93. The flexibility in these products, the reason that I really like them is you have a minimum of less than $4,000 that you're going to put in, but you can dump in $64,000 a year. That's a huge range. That's a lot of flexibility. And if you don't put that much money in, that extra space that you didn't use carries over and you can fill it up in a later year. Okay. Now, if you're a 40-year-old male and you get a policy, or you're looking at a policy like this, and you have no interest in putting in 64,000, don't get 1.1 million in death benefit unless you just want that death benefit. Okay. This is just showing you the maximum blend and what's possible in these things. I have a lot of people that sign up for the 1.1 million so they can optimize that split. Even if they're thinking maybe they're only going to put 50,000 a year in, to add that extra 100,000 in death benefit might be just $100 a year or $200 for the year. But it gives them the flexibility to dump in another $14,000 if they get the opportunity to. So sometimes they'll just start with that maximum blend just in case they want to use that space. And if they don't end up using that space, we can always get rid of that term insurance. It doesn't have to stick around being a drag on the policy if you're not going to use that MEC space. Okay. Our next column, annual account value charge. Not every carrier charges this fee, but some do. This is like an asset under management fee. Basically, the higher the value in your policy, the greater that charge is each year. Okay, it's going to be really cheap in the early years. It can get very expensive. It can be a very expensive add-on in the later year. Wash loan is our next column or our next row. The wash loan is the ability to effectively get your money out of the policy with a net zero cost. Like that's the idea behind a wash. You're going to pay a certain amount of interest and you're going to get an offsetting credit for that interest. Now you'll still have expenses in the policy, but you don't have to worry about a loan. But you don't have to worry about the loan getting no credit and possibly causing a lapse in the policy. We went through a lot of that in one of our earlier videos. So if you have any questions about that, just ask. Next one is our participating index loan. This is where you have the opportunity for arbitrage. This is the one that we got to be careful in when we get late into retirement and if we have $10 million in loans out in our policy. There's fixed and variable rates. In the case of Allianz, it's a 5% fixed cost, and it doesn't impact the growth in the policy. The growth is all still going to happen based on the index growth. So that's generally what we try to use if we expect to get some arbitrage. So if you have an index that can average higher than 5% and you know you can borrow at 5%, you've got a good chance for some long-term arbitrage on that. But you could end up with a year that you get no credit, in which case you're paying the interest and you're not getting an offsetting credit. That's the reason we say be careful with these when we get into our later retirement years. Okay. And you can work with your agent to make sure that you're accessing your cash safely. Okay. Then we have our bonus. In the parentheses, in all of these, I put in parentheses guaranteed rates. Okay. So we have our current bonus amounts and then we have our guaranteed rates. The only place that it doesn't mean a guaranteed rate is right here, this 1%. I'm just highlighting that there's a fee for this particular bonus option, this 40% bonus option. Okay. But like the bonuses here in Allianz, you get a 0.9% guaranteed bonus, or you can utilize a 15% multiplier bonus or a 40% multiplier bonus if you pay a 1% asset fee. Okay. So that's the bonuses that are available. F&G has a 1% bonus. That's available. You may have to have a particular index to be able to take advantage of these bonuses. Okay, they may not be available with all index options in these carriers. We're just highlighting if there are bonus options available. Okay. Uncapped indexes. Are they available? I'm a big fan of uncapped indexes. I don't like to be limited on my potential growth. In general, I don't like to be limited. There's some really good opportunities with a lot of indexes out there that you could get really good returns if they're uncapped, but not all uncapped indexes are created equal. Okay. But I am highlighting if they are available in any particular product. Okay. Notice I don't have Pacific Life filled out here. I don't have access to the Pacific Life one. One of my team members does though, and he's going to get me this information so we can finish filling this out. They do have uncapped index options. They do come at quite a cost. Some of them come at quite a cost. I'm not sure the specific details there. Then we have our load fees. The load fee is an amount that comes right off the top of any new money that you put into a policy. Load fees generally range from like 4% up to 15% I've seen. So a general normal range would be 4 to 10% that we see. If it's something outside of that range, might raise some red flags. Okay. And we highlight what the load fees are on each of these products. Sometimes there's a load fee that's a current rate, and then the guaranteed amount, meaning they can change it, is going to be different. Again, we're going to put those in parentheses, like you see right here. Okay. Then we have our living benefit riders. All of our IULs come with at least terminal illness and chronic illness. Some of them offer an extra 1 or 2 riders. That might be another feature that might lead a client to choose one over the other, especially if everything else is very similar in design for their particular situation. Okay. The surrender charge period. How many years do you have to keep this thing without worrying about a fee if you cancel it, or having the potential surrender charges impacting your access to the cash value? Generally, the higher the commissionable amount that you pay, the higher those surrender charges are going to be. Okay. So it's not just the years that we're interested in. Certainly the amount makes a difference as well. You can have a policy like Transamerica with the proper design. So it's a 15-year surrender charge period, which sounds terrible. But with a proper design, it can have very low costs in it at the beginning, and the surrender charge would be very low. So it may make sense to do something like that, even though it's a 15-year surrender charge period, because in the later years, we're talking a couple $100 for a surrender charge fee, not very big of an impact. Okay. And it's the same thing for all these. If we can design a really nice blended design, we're going to see lower surrender charges in those products. Then we have our no lapse guarantee. The no lapse guarantee can vary quite a bit. That just tells you if you make the minimum payment, that's where the minimum makes a difference. If you make the minimum payment, you have a guarantee that no matter what happens with the index, your policy will not lapse. So for that specified number of years. Okay. Now, most of my clients, we're max funding these things. We're nowhere near the minimum. It's just good to know, you never know what can happen. Sometimes you may end up needing to fund it at a minimum amount, but most of these minimums, they're cumulative. So like if the minimum is $3,000 and you put in $15,000 in the first year, you just covered that minimum for 5 years. You don't have to put in $3,000 each separate year. It's just that the cumulative has to meet the minimum requirements. Okay. And then we may have some extra notes. Okay. So we'll take a look at each of these. So let's get into this. We've got Allianz. We're just going to go through each one of these now fairly quickly. And if you have questions, put them in the comment section. Allianz has a minimum of 100,000. We can do a 10-to-1 design that gets us 1.1 million on a scaled up design. You can put in 64,000. The commission on that is essentially $2,100. That's on the target premium. Now, most of these product policies will pay a little bit, like maybe 2% or 1% or 2.5% or 3% on anything above target premium. So if you put in 100,000 and the target premium's 2,000, you're going to get that. The agent's going to make like 2% on that extra $98,000. Okay, so that's like an extra $1,800 in commission. For the most part, just know that this number is a good indicator on if it's the proper design. Okay, not always, but in almost every case. Okay, then we have our minimum premium. So for Allianz, that minimum premium $3,700. They don't have an account value charge. Their wash loan, these are guaranteed. One of the nice things about Allianz, almost all of this stuff, actually everything on this list, these are all guaranteed. They can't change it. Okay, we're going to see that it's not the case with a lot of these other carriers. So we get a 0.91% net cost for the first 10 years if you're using a wash loan with Allianz. And after 11 years, you're going to get a net gain of 0.04%. That's almost nothing. So we'll just assume it's a wash. Okay, 0.04%, negligible. Okay. But it does wash, and it's guaranteed to wash at that point. Their their participating index loan is fixed at 5%. That will not change. It's fixed 5% for the life of the policy. That's really good. I actually really like the participating index loans in general. I just look at it like the cash value in our policy is a line of credit. What is my cost to access that? I don't want to think about whether it's impacting the growth or not. I just want to let the policy perform as it would perform because I'm happy with the average that the indexes do. And the only way I'm going to get that average is if I'm in those indexes every single year. So if I want to take a loan, I'm going to consider what is the actual cost for me borrowing that money. In this case, it's 5%. Okay. Bonuses, we've got a 0.9 classic bonus. We've got the 15% multiplier and the 40% multiplier that costs 1%. The uncapped index options, they've got 2 of them, Bloomberg and PIMCO, both of them excellent uncapped index options in my opinion. The load fees for the first 9 years is 8%. After that, it's 4% a year. Now you're going to see that is the case for a lot of carriers. Well, they'll start out with a higher load fee and they'll reduce it. Sometimes people will ask me, well, maybe I should wait until year 10 before I start dumping a bunch of money in. Well, you're talking about waiting 10 years on compounding on money to save 4%, to save a 4% cost. Remember, this is a one-time cost. The average return in the 40% bonus option with Allianz, the average return right now with the current participation rates over the last 15 years is over 12% after that 1% fee. So if you wait 10 years, you missed out on a ton of compounding to try and save 4% on a load fee. So don't worry about it. The load fees essentially help the insurance companies cover taxes that go to the states. Every time you make a payment on your premium, there's a tax that's owed to the state. The insurance companies pay that. Basically, you don't get charged it as a tax, but they take it out as a load fee. Okay. It probably covers other expenses as well. Getting all their office workers, everybody who has to process that stuff, it helps to cover those costs. So we see a higher amount in the first few years generally, and then a lower amount, although sometimes it might just be a flat amount the whole time. Okay. Then we have our living benefit riders. I talked about that a little bit earlier. Allianz has a 12-year surrender charge period and a 10-year no lapse guarantee. In the notes section, we'll note that there is a lock feature that's available for the volatility indexes. That means you have the ability throughout the year, anytime that the stock market is open, you can go in and lock in the value for the rest of your year. So from your annual point to point, you can just lock in that rate. And then when your annual point to point comes around, it'll reset to wherever the index is at that point. It's a good feature. I wouldn't recommend using it all the time because essentially you're trying to time the market, and it's really hard to time the market. But there could be some times where you just really want to protect your downside and not have to worry about a crash that seems like it may be coming up and may in fact happen, in which case you can lock it and sleep easy. Okay, so it's a neat feature. Also, the max blended design is different if you're under the age of 18 or over the age of 50. So our max blended design in general is a 10-to-1 split. Well, if you're under the age of 18 or over 50, it's a 5-to-1 split. So it changes a little bit. Not really that big of a deal because the MEC limits go up so much for a 50-year-old. It hurts us in the case of the 18-year-olds or under 18, so for our kids. But in general, you're not going to do that much death benefit for a kid anyways. And most IUL carriers are going to limit you to about $1 million on a kid anyways. So we end up, the commission is very low. So even though we would have to increase it to get up to $1 million, it would almost double the commission. It's still a pretty low commission because this insurance is just cheap for kids. So something to be aware of though. So there's Allianz. Next we have F&G. This is like my number 2 choice. They're a smaller carrier, so they don't have as good of Oh, you know what? I should probably put Comdex scores in here if I can find that. Allianz is like A plus credit ratings, somewhere in the mid 90s for Comdex score. So that's like how good are these carriers? How stable are they? F&G is generally a smaller carrier. They recently got bought by the National Title Company, so Fidelity Title Company, which helped to increase and bump up their credit rating from in the B's to the A's, but their Comdex score is still pretty low. So that's why they're not my number one choice, but they are a good smaller carrier with a really good product. Their minimum death benefit is $50,000, and they allow us a very similar design. So we can get a 9-to-1 split design. Now, the only caveat here is their split design doesn't begin until you're at 150,000 in base death benefit. Okay. So we can do between 50 and 150 with no blend with F&G. Once we get above 150, we can start blending it in. So since theirs is a 9-to-1 blend, the scaled up blend is 1.5 million in death benefit. Well, the MEC limit for 1.5 million in death benefit with F&G is 64,000. That's basically the same as a 1.1 million death benefit with Allianz. Okay, it's funny how these are very similar. The commission almost the same as well. We're talking less than $100 difference for 1.5 million in death benefit with F&G. The minimum premium is about $500 lower with F&G for that same amount. And that gets us a no lapse guarantee for a little bit longer, so 15 years. So we can pay that minimum amount for 15 years if we had to and not have to worry about that lapse. Now, after 15 years, if you've only put the minimum in, you better be worrying about a lapse. I never recommend people buy this if they have any eyes on paying in the minimum amounts, at least over the long term. You can certainly not pay it in any given year or pay the minimum amounts for a number of years if you want to, and you've already built up your cash value. There's no account value charge. The wash loan for years 1 through 10, it's a variable rate, and there's a 2% net cost, okay, for those first 10 years. Here with Allianz, remember, it's a 0.91 net cost. After year 11 with F&G, it's a wash, basically the same as Allianz. So guaranteed to be a wash too. So I like this. I like this product in that we can do a good design. It's got nice low costs, and we do have that wash loan available when we get to older age and late in retirement. Their participating index loan, it's a variable rate, but it maxes out at 5%. So Allianz is 5% all the time. F&Gs could actually be lower than 5%, but it will max at 5%. So that one's a pretty cool deal. Last year it was at 4.5%. I imagine now it's probably up at 5%, if not higher. Or, well, I can't go higher, but it would be higher if it could be because interest rates have gone up, right? So that one's a good option as well. And it has a 1% bonus that's available with certain index options that they have. And they do have an uncapped index option with Barclays. Notice I have in parentheses this spread. There is no spread with their current rates, but they do reserve the right to add a spread. So that's the one downside about this product that I'm not thrilled about. We plan on owning these products for like 50, 60, 70 years, maybe longer in some cases, right? I generally don't want the insurance company to reserve the right to change a whole lot of things on these. You just have to pay more attention to it. If you're not making money for some reason in any given year, you've got to do some investigating and figure out why. What did they change? What happened? If it's not obvious that it's because the index was down, what else is the reason? So that's the only one downside. It's not a big deal, but you got to recognize that that's a risk that they could add a spread at some point. Their load fees, 9% for the first 10 years, 5% after year 11. They have 3 living benefit riders, so terminal illness, critical illness, and chronic illness. Their surrender charge period, 15 years, and their no lapse period, 15 years. And there's no split design for juveniles. So while we can do a 5-to-1 blend with Allianz, we can't do any type of a blend when it comes to a juvenile policy. So you could end up, if you had a $500,000 or $1 million death benefit on a juvenile, you're definitely going to have lower costs with this Allianz product because we can do that split design and reduce that commission. The commission is going to be basically 10 times higher for $1 million as opposed to the $100,000 base. So something to consider. Next, we've got PacLife. I don't have all of these filled in, but I did get some numbers. They have a minimum death benefit of $40,000. They can allow a 5-to-1 split design. So if we have a $40,000 minimum, we can have a total of $240,000 with that optimum split. And if we scale that up to $1 million, we have a $41,000 MEC limit. The target premium at that level, $4,000. So you can see it's higher than these other two at $4,000. And that's at $1 million death benefit. This one's at 1.5. This one's at 1.1. And the minimum for that is also higher than both of those other two. PacLife does charge an annual account value charge of 0.75%. Remember, this is like your asset under management fee. So 0.75%. That's kind of similar to a 1% asset under management fee that you might get if you were to go have somebody manage your money in the stock market. Okay. I don't have anything else filled in except the load fees. The load fees are 6% all the time. They've got terminal illness and chronic illness. They have a 9-year surrender charge, and you have a no lapse guarantee that you can choose at issue how long you want that no lapse guarantee to be. Generally, the longer you make that no lapse guarantee, the higher the cost. So they could charge you more if you choose something that's more than whatever the minimum is. Okay. And we don't have any other notes on that. National Life. National Life allows a 3-to-1 blend design. So we can do a $100,000 death benefit and have $25,000 be the base, $75,000 split. That's a really, really small commission, teeny tiny commission on a policy that doesn't have a whole lot of MEC space. So this is a good choice. Oftentimes, if somebody wants a very low premium and they want to make sure that their expenses are going to be minimized inside of this thing. Okay. Now, there's some other things to consider. There is an account value charge in this product, but it's not very big, 0.35% for 25 years. Okay. So it is something, and it does add to the expenses, but it doesn't add a whole lot. With our blended scaled up design, so this is figuring $1 million, we can put in $49,000 a year. That comes with a target premium of $3,200. So you can see we're higher than the other two, our top two choices, Allianz and F&G, but not by a whole lot. So we can still do a pretty good design with this at $1 million. We just can't quite put as much money into it. And our minimum is also higher. So something to consider when you're looking at this product. We can get nice low costs inside of it, but you might not be able to put quite as much money in. Okay. We have the account value charge. We went over that. After 26 years, there isn't one. The wash loan, it's a variable rate, and the net cost is 0.5% for the first 10 years. After year 11, guaranteed to wash. Participating index loan is variable. So National Life, it can go up to 6%. Okay, it's not currently at 6%, but it can go up. Now, they also claim they have some type of a fixed participating index loan at 5%. That one's kind of weird language because it's actually not fixed. It can adjust. So I'm not sure what that's about. In general, we don't really look at it. We're either using the variable or we're using the wash loan. Okay. And then they do have a bonus available with the pace setter. It's actually available with both of these, but the highest bonus is with the pace setter uncapped index option. These two are both uncapped. But it doesn't begin until year 6. So something to be aware of. Their load fee, 6% for the life of the policy. That's a guaranteed amount. And they have 4 living benefit riders. This is usually the draw. What might tip the scales in National Life's favor is people like to have that extra living benefit rider, depending on the risks that they think they might end up needing it, right? So the surrender charge period, 10 years with National Life, and the no lapse guarantee, also 10 years. And we have no notes for this one. North American, $100,000 minimum. They do not allow a blended design. So there is no scaled up blend. At $1 million, you can put the most money into here among all these policies, $71,000. But you're going to pay a $20,000 commission on that. And your minimum premium is more than double these other ones. So it comes at a steep cost to be able to do that. They also have the highest annual account value charge at 1.25%. So some definite things to be aware of. This product can be good at very low numbers where we don't have to worry about, how it's going to compare to these other ones. It'll compare favorably until we start doing a blended design, and that's when it starts to lose the luster, right? But it does still have that 1.25% cost. Now there is something to offset that cost. You'll see when we get to the bonus. Actually, I don't have the bonus listed here. This is the guaranteed amount. Let me put this in parentheses. We're still trying to improve this thing. So the bonus is actually in 1 through 10. It's currently 1.65%. And in 11 plus, they think that they're going to increase it to 2.65%. Okay. But they reserve the right to change it to 0.5% in any of these years. So under their current rates, and it's possible, this is a big company. They're good. It's possible that they will keep this 1.65% around for a long time and increase it to 2.65 when you get after year 10. That offsets this annual account value charge. Okay, we're making more than that on the bonus. And when you see an illustration, it illustrates these. These are probably going to change when we get AG 49B. I don't imagine they're going to allow them to do this when there's a 0.5 guarantee. So this is something we're going to be watching for. But just know that the illustration is going to illustrate a 2.65 bonus in years 11 plus, even though the company could reduce that down to 0.5% anytime. Okay, so there is some risk in this product with regards to that bonus. Now the wash loan, it washes in year 6 plus. This is one of the earliest washes. PennMutual does the same thing, but this is one of the earliest washes. It is a guaranteed wash. Their participating index loan, they have a variable and they have a fixed. It maxes out at 6% with the variable and it maxes out at 8% with the fixed. I don't know why you would choose this. I'm not sure what the difference is here on this, because the fixeds are always adjustable when they're in the participating index side. So it's just kind of interesting how they lay this stuff out. Oftentimes, if it's something that's confusing and I don't really sell much of that product, I don't spend much time digging into it. So that's why I tell you, I don't really know why they list it that way. Like, there's just some playing around with verbiage that confuses even experienced agents. Okay. They do have an uncapped index option, the Fidelity index. Okay. And their load fee, currently 5%. So that's on the low end, but they do reserve the right to change it to 7.5%. So that's something to be aware of. We do like this 5% one. Even if it goes up to the 7.5%, that's still kind of in the range where it's not too bad. And you could get that 5% for a number of years before they ever increase it, right? So not too bad there. They have 3 living benefit riders. They have a 10-year surrender charge period, and their no lapse guarantee is 20 years if you're under the age of 54, 15 years if you're over the age of 55. Okay, Securian. Securian has a $100,000 minimum for adults, $50,000 for minors. They allow a 4-to-1 blend design. So if we have a $100,000 minimum, we can blend in $400,000 for a total of $500,000. At the scaled up blend, that gets us to $1 million. You can put in $49,000 a year. The target premium for that, $28.90. So we're in there, It's basically we're paying for a $200,000 base premium instead of 100,000, which is what this target premium is, and 150,000, which is what this target premium is. So it's not surprising this is a little bit higher. The minimum premium, though, falls right in line with our good products over here. So Securian is not a bad product. It happens to be one of the better ones that's available in New York. There's not many that are available in New York. National Life and Securian. I'm pretty sure National Life's available in New York. But Securian is available in New York, and that's usually one we look towards for our New York clients. No annual account value charge, which we appreciate. Their wash loan is a 1% net cost for the first 10 years, and then a guaranteed wash. They have a participating index loan that's 4.75% fixed, but that is a variable. Yeah, they've got some things down here that we'll talk about in a minute. That's what that's for. They don't have a bonus. Oh, I didn't put that in here. Don't have a bonus. They do have some uncapped index options, and they can be pretty good. Uncapped index options not available in New York. Their load fees 5.5%. So we got a good cost on those load fees. That's a guaranteed number. They have a terminal illness and chronic illness, 9-year surrender charge period, and 9-year no lapse guarantee. Now, this variable, the participating index loan, it's available after the first policy anniversary. Interest will not be charged if the entire loan is repaid within 90 days. Now, that's called the short-term policy loan, and there is a limit for that benefit, and that's 3 times throughout the life of the policy. So most of the people on my channel, we plan on borrowing quite a bit more than that, so this is not really going to be an impact. But it's not real obvious what the limits are on this when you're just exploring the product. So you might see that this is available but not realize there's only 3 times that you can do that. It's for a maximum loan amount of $50,000, and you can only do it once every 24 months. And you can't have any other outstanding policy loans. So there's a lot of caveats around that. The basic target for this is somebody who basically never borrows from their policy, but needs to for a short term every once in a while just to meet some particular need. And otherwise, they don't touch the cash value in their policy. Okay. The variable rate here, though, is max. The max of this one, so the guarantee is it's max 1% above the current fixed account crediting rate. So they can adjust it to a max of 1% above that. Okay. Next, we have PennMutual. This was one that I spent some time earlier today filling out. And so I've got a little bit of insights in this one. This one's an interesting one. We have a $50,000 minimum. They do allow blended design of 4-to-1. The thing to know about this is it's not really apparent if there's an advantage to doing that 4-to-1 design. Let me finish going through this and then we'll talk about that some more. So their scaled up blend would be a $500,000 death benefit. At $1 million for this one, for comparison, we're at $53,000 that you can put in. That's our MEC limit, $53,000. The commission that it pays out is $10,000. That's half of North Americans and 5 times as much as F&G and Allianz. Okay, so that's a big deal. That's a big commission comparative to those other ones. As such, this minimum is right up there with North Americans. So you're not going to be able to have $1 million death benefit and have the flexibility to put in these nice low amounts of $3,000. Okay, so something to be aware of. They don't charge an annual account value charge. Their wash loan, it's a variable rate, so they currently charge 4%. And for the first 5 years, there's a 1% net cost. So while like this one here with Securian, this is a 1% net cost as well. They're going to charge you 4%, you get a credit of 3. In this case, they'll charge you 5.7, but you'll get a credit of 4.7. Okay, so it ends up being the same net cost there. Now, after year 6, it washes, but it's not a guarantee that it will wash. There could be a net 1% cost that they change it to. So they do reserve the right to adjust that from a wash to a net 1% cost. Their participating index loan is currently 5%, but they reserve the right to increase that up to 8%. Their bonus, this is not index dependent. This is just a persistency bonus. It's 0.25%. So in years 1 through 10, and in years 11 plus, they'll double that up to 0.5%. So this is a bonus you get no matter which index option you're choosing, as long as you've had the policy for over 11 years. They do have uncapped index options, but it's just S&P options. And you get a 50% participation rate. Yes, it's uncapped, but essentially for you to get the equivalent of a 10% cap on this, to max it out, the S&P is going to have a 20% return. How often does the S&P return 20%? It does sometimes. For sure, it does sometimes. But there's a lot of times the S&P is negative, or the S&P has a lower than 20% return, in which case, is this the type of index that you're beneficial to just sit in, set it, and forget it? I don't think it is. Okay. Maybe this 2-year with the 68% participation rate, but I'm generally not a fan of multi-year index options like that because you don't get that annual compounding. You wait and you get a 2-year compounding. So I'm just not as enamored with these types of index options. You can do a 1% or a 1% floor. So these have a 0% floor, but you can do the S&P 1 year with a 1% floor for a 41% participation rate. So instead of a 50%, you're guaranteed to get that 1% growth. Not a huge fan. The load fees, 8% for the first year, 5% in years 2 plus, but they do reserve the right to increase it to 8%. The living benefit riders, terminal illness, chronic illness, 9-year surrender charge. This one has a nice no lapse guarantee. It's 30 years or age 85. Now this explains to me why this minimum premium is so high. That's how they can keep this 30-year no lapse guarantee, because they do have a very high minimum. It doesn't mean you have to put in that much for every year. If you put in less than that on average, you just don't have that no lapse guarantee. Okay. So it's 30 years or age 85 with a 5-year minimum. So that means if you're 81 years old, you start a policy, you get at least 5 years of a no lapse guarantee at whatever the minimum is. It's not going to be this minimum. It'll be quite a bit higher if you're that old and you're getting $1 million in death benefit. They do have a dollar cost averaging account, which means if you have the premiums, you're doing an annual premium, and you would rather have 12 monthly point-to-points, and you put that money in and you want it spread out over those 12 monthly point-to-points, they're going to credit you 10% interest while it's waiting to be added to the index. So that's nice. It's kind of gimmicky. It doesn't make up for some of the other limitations that I see in here, but it's nice to know that your money is going to be earning something good. In my national life policy, they have this similar thing, but they don't give us an interest credit above whatever the fixed amount is, which is like 2% or 2.5%. So while my money's waiting to get allocated, I only make 2.5%. So this definitely looks better on that regard, but it's only for the funds for that year. So like the difference between 2% and 10% on funds that are waiting to get in month after month is going to be pretty negligible. So that's why I say it's kind of gimmicky, but it's better than nothing. Now, the thing that I wanted to talk about in brief with the pen is this blended design. If I run this without a blend, you actually have more cash value in the first year than when I do a blended design. Now, generally, we do a blended design in order to get access to more cash value and reduce the expenses, and that ends up in longer term growth, better cash value long term. In this case, it doesn't benefit you in the early years. Like, you don't have access to more cash value. So the policy that I had illustrated on this one, if you put in the maximum, which is 53,662, you're going to have access to like $42,000 your account value is $42,354, but you only have access to $14,304. That's a lot of surrender charges, and that's because that commission is high, right? So the difference between those two numbers is the surrender charges. Normally, when I do a blended design, like when we do this 4-to-1 design here with Securian, we're going to have a lot of cash value available because the underlying commission is quite a bit lower. So with a similar design for Securian, I would say instead of 14,000 in cash value, there's probably like 35 or 40,000 in cash value. With Penn, you're only going to get 14. This is with their IUL. I really like Penn's whole life. Not a big fan of their IUL. If I don't do the blended design, the cash value is $15,935. So you have an extra $1,600 in cash value in that first year if I don't do the blended design. Now, it pays a lot higher commission. It's a $17,000 commission instead of a $10,000 commission. So the minimum is going to be higher. Okay. And the costs inside that policy are actually going to be higher. So in the first year, we don't see a difference. So you might have an agent that shows you a policy that's a little bit better early in cash value in the design compared to if they do a reduced target premium design, a reduced commission design. But when we look out 30 years, this blended design is actually $100,000 higher in cash value than the non-blended design. Now that's assuming 30 years of payments at $53,000 a year. So there's not a whole lot of difference unless you're funding it at that much. Like if you're funding it at a lot lower level, you're going to see less difference than $100,000, right? So in general, I generally just avoid this product. But if you're interested in that product, just know that there is some weird things happening with the design. The split is available, but it may or may not really benefit you to utilize that split. Okay, so definitely take a look at the minimum amounts, weigh how that target premium weighs into it, and then of course everything else with that particular product. Well, let's move on to Transamerica. Transamerica 100,000 minimum. They allow a 10-to-1 design. They're the only other one besides Allianz that does the 10-to-1 design. There is no blended design for juveniles. So again, we're in the case where if you have a juvenile and you want to have more than 100,000 death benefit, you're probably going to find some more benefit going with Allianz and getting that blended design there. The scale up blend then at 1.1 million, same as Allianz, but your MEC limit's 54,000. So you can put 64 into an Allianz at 1.1 million, but only 54 in Transamerica. Here's where Transamerica really shines as from an expense standpoint, nice low commission. So when we do this blended design, that target premium is the lowest among all of these at this scaled up blend. As such, the minimum is lower. Okay. Now they kind of make up for this in other areas, not to the commissions to the agent, but in possible charges to you. And that's here in this 0.06% per month annual charge. So that adds up to 0.72% for the year. Okay. Comparable to PacLife at 0.75. Okay. So that's a 0.72 annual charge. That can get expensive later on in the policy. Okay. Now, they do not have a participating index loan. Kind of a bummer. If you're planning on accessing the cash values to go invest in other stuff, this is not going to be a good product for that. If you're not planning on doing that, you just want to put money in and have nice low costs starting out, this can be a good product for that. But they don't have uncapped index options either. We'll get to that. They do have a wash loan. It's a 1% net cost for the first 10 years. After years 11 plus, it's a wash, but not by guarantee. It could actually be a 0.25% net cost. So they reserve a small adjustment there. Now, that's not a huge cost, 0.25%, not a huge cost, but it's something. But they don't have a participating index loan, which is one of the main reasons why we don't sell this product. They don't have a bonus, and they don't have any uncapped index options. You only have the S&P index. It is, however, one of the highest caps out there for an S&P 1 year point to point. So it's generally the higher caps, and I think that's where you're paying this money from. I mean, this buys you that higher cap essentially. Okay. So right now, or the last time I looked, it was like a 13% cap. I think Allianz on their S&P option is like an 11.5% cap. So that goes to show you the slight differences, what that 0.06 can buy you in additional cap. But we don't even use that option for Allianz because it's not their best index. The load fees are nice and low as well. They start out at 4% with the Transamerica product. So when we look at this product, really, really low expenses in this thing starting out. There is a chance that they can change it. They do reserve the right to change that to a 6% load fee. So that's something to be aware of. So from an expense standpoint, this is a great product. Again, this is not their current product. They just came out with a new one. This is their old one. Their new product, I did a video on that, and I'll link to that up here when I put this into a video later. Obviously, I can't link to it live, but I did a review on that product, and you can go over the differences. Essentially, some things got better, some things got worse. Okay. Living benefit riders, they have 3 of them. They have a 15-year surrender charge period, and they have a no lapse guarantee of 0 to 60. If you're under 60, essentially you get 20 years, or up to age 65. If you buy this product between 61 and 65, you get at least a 5-year no lapse guarantee. Okay. There's a floor of 0.75%, but that's offset by that monthly charge. And then they don't have that blended design for juveniles. All right, Mutual of Omaha. This is another interesting one. Mutual of Omaha actually does allow for a blended design, but there is no benefit to the client or you, the agent, for doing a blended design, unless they just want extra death benefit. Because when you do a blended design with Mutual of Omaha, the MEC limit reduces. So they're not giving you any MEC space, even though you're blending in some extra death benefit with the policy. So it doesn't work the same way every other IUL works when we do a blended design. So essentially, I don't ever sell this product. It ends up being a high commission. You can see here, 1 million death benefit, you can put in $49,000 a year, and that's a commission of $12,600. Your minimum premium, nice and high because of that, and those are going to impact your cash values. They have a wash loan that has a 2% net cost for the first 9 years. That's on the higher end. It washes after year 10 plus. We have a guaranteed wash. Their participating index loan is currently 4%, but it could go up to 6%. So it's a good rate to start with, but it could go up to 6%. They don't have a bonus. Their uncapped index option is an S&P with a 50% participation rate, and they could reduce that participation rate down to 20%. So that is not a good uncapped index option in my opinion. Load fee is 4.5%. This is a good, nice low load fee up to the target premium. And then after that, it drops down to 3% on anything in excess of target. Those are really low. It's going to help to illustrate really good if you're putting lots of money in there, at least from an expense standpoint for those load fees. But they do reserve the right to increase those load fees to 10% if they want to. So something to be aware of. The numbers look good up front. They could change to not look good. They have a terminal illness and chronic illness, 14-year surrender charge, and 10-year no lapse guarantee. And I don't think we have any notes on those. All right. We're almost done here, folks. We just have a couple more. Actually, it's just one more that we really have details on. Nationwide. And I've been contracted with them for a while. I never sell a product. And you're going to find out why here in a minute. They basically reserve the right to change everything inside this policy to make it look worse, or to make it actually perform worse. So 100,000 minimum. They don't allow a blended design. So our scaled up is you can put $53,000 into it. It's going to pay out a $14,000 commission. 14,000 plus. Your minimum premium, though, is nice and low, so you may not realize that you're paying out such a big commission. Those expenses eventually get recouped, okay? So we got to realize that. Even though it may not be obvious, the target premium is important in all of these products. They do have an annual account charge based on the value of the policy for the first 10 years. I couldn't find what that amount was. I just saw that they did have one, and they reserve the right to change it so they can charge it to you in every year. So that one's kind of sneaky. Their wash loan, I don't remember what it is to start with. It's something similar to this. I just highlighted the guarantees. It's possible that this never washes. They reserve the right to charge you 3.9% and credit you 1% anytime that they want to. So you could have, in the absolute best case scenario in retirement, where you're trying to make sure your policy doesn't lapse, you're taking the safest loans, which is your wash loans, you could have a 2.9% cost, net cost. Not a big fan of that. Participating index loan, they currently charge 5%, but they reserve the right to change that up to 8%, which is among the highest of our participating index loans. They do have a bonus of 0.6%, but they reserve the right to take that away if they want to. They have a couple of uncapped index options, and their uncapped index options are actually pretty good. I like their uncapped index options. It's one of the good things about their product. Their load fee, 8% for the first year, 6% after that, which puts it like right in the middle, but they reserve the right to change it to 10% if they want to. These are all the things I don't like. If we're going to have a product for the next several decades, I don't want the insurance company to be able to just change random things on it that could impact our growth and make it hard for us to realize what they're doing. That's really the bottom line is I want to know what changes are going on in my policy if they're happening. And if you reserve the right to change 12 different things, I've got to figure out what you changed year after year. I'm going to have to watch that thing like a hawk. I don't want to have to do that. So I generally just don't sell this product. I'm not going to own this product either myself. They have a 10-year surrender charge, 3 living benefit riders, 20-year no lapse guarantee. I don't have anything on AIGs. It's now called CoreBridge. So if any of you guys have that information out there, please send that to me. I would love to fill this in. Columbus Life, had an agent tell me that's their favorite IUL product. I don't see why. I think I'm contracted with Columbus Life, but I think that's where I got this information. I don't remember, but I've never seen a good design from them. So I'm interested, though. If you're with Columbus Life, send me something that matches these parameters and let me know how you would fill in these blanks. They don't charge an annual account value charge. Their wash loan is a net 0.5% cost, which is good for the first 10 years. Like it's at the lower end of the cost. It washes after year 11, but the guarantee is that it could be a 0.5 cost in the long term. So they do reserve the right to charge you and not let that wash in the long term. Their participating index loan is a 6%, and that should be fixed for the life of the policy. I don't have notes otherwise, so I'm assuming that's what I put in there. They do have a persistency bonus in years 11 plus of 0.25%. I don't know if they have uncapped index options. Their load fees, though, are fairly high at 8.75%. So this is the highest in our list here, actually, and it doesn't drop down. So it may start out slightly lower than F&Gs, but F&Gs goes down after 10 years. This one does not go down. You have a couple of living benefit riders, and then a 10-year surrender charge and a 10-year no lapse guarantee. So that's it for our spreadsheet. What did you guys think of that? Be sure to tell me in the comment. If you appreciate this content, be sure you're hitting that like button. Subscribe to the channel if you're interested in following along. Everything that we put out here is about transparency in this industry. And I've found that it is a great way to do business. So I appreciate meeting with every single one of you who watch my videos and decide that you want to get your product from me. Know that every product I design is designed to optimize for your cash growth, minimize the commissions and the expenses inside the policy. Unless there's some other really compelling reason why we don't. But if there's a reason why we don't, you're going to know what it is, because I walk all of my clients through how we design a policy, why we design it, why we're designing it like that for them. Because ultimately, I want you to know as much about this product as possible if you're going to own it. Not just this one, but we do whole life as well. I like whole life. I like IUL. I own both. I think it's important that you understand how the product works that you own, because something can happen to your agent. You know, I could get hit by a bus a week after you buy your policy. And if you were relying on me for understanding your plan and how to manage your policy in the future, you're going to be in trouble. You're going to likely get assigned a new agent from the insurance company that doesn't know what your plan was, doesn't know why we designed it the way we do, may not even know how to design the policies the way that we do, let alone how to manage them in the future for what we're trying to do. In that situation, it's best that you know what you're doing. If you don't, though, we do have a team. I have a team of agents who have signed up and joined under me that I train so they know what we're doing. So you'll be able to ask one of them to be your servicing agent if something were to happen to me. Okay. But ideally, my videos will live on and you'll be able to rewatch them and understand what's going on. I've got a really cool, I meet with everybody via Zoom, and there's a really cool app that I just started using that will automatically send you a link to our Zoom meeting so that you'll have that. So when we talk about your plan, you're going to have that video and you can download that video and keep it so you can rewatch it in the future. So pretty awesome. I've got really good feedback from people on that already. They really appreciate that. That was something that we just instituted. I didn't even know it was available. Normally I would have to save that video, upload it as a private video, and then try and share it with you guys. Now I don't have to worry about going through all those steps. And so I would only do that, if somebody requested it. But now it's automatic. You get that link. And I think that's going to be a big help for everybody. So if you're interested in signing up for a meeting with me, that link is right there, scrolling along the bottom, calendly.com/cashflowpro. I have a bunch of different meeting options, but a 20-minute free consult is available to anybody. Anytime you're talking to me about a possible policy, you can utilize the free meeting options. I don't answer the phone because there's so much spam phone calls, but one of my meeting options is a 10-minute phone call options. So if you want to talk to me via phone, I still get on via Zoom, but you can just dial into it and we can talk. And it's a 10-minute one. There's more of those meeting options available. There's no cost for that. So if you want to chat, just sign up for one of those. If you just have a quick question or whatever, you can always email me with questions, but it's best if you want anything specific, if you want to talk details, let's meet via Zoom. I always love to be able to share my screen with you and show you what I'm talking about. I may have answers for you on your questions, but a lot of times it's easier to understand it if you can also see what we're talking about. So that's my preference. Appreciate you guys joining me today. We'll be back again on Thursday. Again, we're going to have a PennMutual policy to review, and that one should be a good one. So if you have a policy to review, either an in-force policy, or maybe you have an illustration you got from somebody else, or you're just interested in seeing an illustration, feel free to reach out to me. And if you're okay with having that done live, let me know. You can send it to me, and I'll do that during one of my Tuesday or Thursday meetings, just like we're going to do on Thursday, my live streams. So I'm always looking forward to that. It's going to help basically shed the light on policies that are being sold out there, the designs that people are getting out there. I think there's a lot of value in seeing this information. So if you agree, keep an eye out for those. If you hit the notification bell on the subscribe for here, you'll get notified when we go live, so you won't miss these.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.